So friends, in today's topic we shall discuss about retail credit. Now what a retail credit is, when it is given to individuals, right? Not to entities. Individuals like car loan, home loan, personal loan, right? Consumer loan. So these are called retail credits. So when they are given to individuals, to persons, not to entities, not to any corporate. So we call them retail credit, right? So introduction to retail credit is financing method. How do we finance, provide loan services to retail consumers for goods and services? So there are certain credit which are given for you can say goods and services at a micro level. Lending funds to consumers wishing to purchase high ticket items but are short on capital, like home loan or car loan, enables a greater number of consumers access to retailers goods, right? So characteristics of a retail credit: small size loan, they are not very big loans. Home loan may be slightly on the higher side, otherwise car loan and other consumer loans are on a lower side. Large number of customers with diversified portfolios, mostly individuals or small organizations. Products standardized, operation centralized. Quick credit related decisions are taken. So we have this credit score and 5 C's of credit, which includes character, capacity, capital, collateral, and conditions. 5 C's of credit, designed to cover various risks of segment. What are the features? Types of facilities: secured, unsecured. Secured means when it is secured by way of obtaining any collateral, any security, like we keep property papers of a house or a shop or a factory, whatever we keep with ourselves, or we hypothecate the car, we hypothecate the stock also. So those are secured. Unsecured, just like personal loan, credit card, right? So these are called unsecured facilities, which are not covered by any collateral security, any security. So what a collateral is, it is a secondary security. Instead of primary security, we take from a borrower. In case borrower does not repay our loan, we can recover our dues, right? Then interest we charge, tenure, that is repayment period, LTV ratio. I think you all know we never give full amount of loan to any consumer. We only give a part of it, means 85% of the loan amount. Suppose the cost of the house is 50 lakhs, so we don't give 50 lakhs as a loan. We ask the consumer or the borrower to contribute 15%, 10% as per the guidelines of the bank. That is called LTV ratio, loan to value ratio, right? So if LTV is 80%, then whatever the value of the car is or a home is, we'll give 80% of that cost only. Rest will be contributed by the borrower, and that is called margin. Then we also see loan eligibility, whether he is eligible, CIBIL is good, his income is good, his whatever salary he is drawing, FIRE, fixed income to obligation ratio, is good or not. Credit scoring, right? What is the credit score? So we assign various marks based on his age, risk category, as well as his investment, his earnings, his longer association with the bank. So we give a score out of 100 if it is more than 40 to 50, depending on the bank's own guidelines. We sanction the loan, otherwise we reject the loan if it is less than 40 or 30 as per the bank guidelines. Then we also check whether the borrower is on a negative list of caution list of RBI or not. The negative list is of RBI, caution list is of the bank. So we have to be careful that borrower is not in that list. So generally this is for corporate or entity accounts. So types of facilities: loans, we give certain loans, term loans, right? For car loan, home loan, loan against property, and overdraft. Overdraft is like a running limit. It's a limit given to a borrower. He can deposit, he can withdraw. The interest will be charged only on the amount which is in debit balance. So overdraft may be against, you can say for business purposes, against stock. So facilities: home loan, personal loan, LAP, loan against property. Credit card is a clean loan, right? Business loan, loan against stock. Again, this is maybe with collateral or without collateral, depending on the type of customer. Then we have these features secured, I told you. So we create a certain charge on the securities. We call them secured, means we have a secondary security or a charge registered with the company or with the any third party, so that to which that product belongs. I'll give an example. Suppose first is lien. Suppose a customer is having a fixed deposit of 1 lakh rupees and he comes to us and he says, I need 20,000 but I don't want to break FD. Otherwise, it will be a loss, huge loss to him. So we advise him to why not to take a loan against fixed deposit without breaking it. In that case, he'll be saved the interest also and penalty if he prematurely cancels it. So we give a loan against fixed deposit. So when we open the account in the system, lien is already automatically marked in the fixed deposit. Lien means there is a charge of the bank. Means till that loan is outstanding, customer cannot withdraw money from that fixed deposit. Right? That is lien. Lien is against fixed deposit. Pledge, when we give a loan against securities like shares, bonds, debentures. Suppose a person is having a lot of shares, units of shares of a particular company or particular mutual fund. We ask that company or the mutual fund to please mark a charge in our favor, in bank's favor, that is called a pledge, right? So some banks treat it as unsecured because shares are very, very volatile, and some treat it as unsecured, some treat it as secured as per their own guidelines. Hypothecation, when we give a loan against car or a loan against overdraft against stock, the charge created on, you must have seen in RC, there is a word written hypothecation. So we write to, when as a banker we give a loan to any borrower, we write to transport department, please mark this our charge since this vehicle has been financed by us. So till then that loan is outstanding, first charge will be of the bank. That charge is called hypothecation. We call it hypothecation clause also. Assignment, when we give a loan against life insurance policy, we call it assignment. So it's a third party charge. We write to insurance company, please attest the signatures and see the bona fides of the policy, and it is the name of the so and so person whose signatures are attested here. Kindly attest them and mark a charge in our favor. Till that loan is there against this policy, customer cannot withdraw or cannot encash that policy even before maturity also. So charge against life insurance policy is called assignment. And mortgage, when we give a loan against home loan or LAP, loan against property, we call it mortgage. We keep the original papers, the whole chain with the bank, and we have an undertaking with the customer that he has deposited of his own will of all the papers. In case a customer does not repay our loan, we can sell that property as a banker and recover our dues. So that charge is called mortgage. So again, I'm repeating, lien is for fixed deposit, pledge is for securities like shares, bonds, debentures, hypothecation, car or OD against stock, assignment, life insurance policy, mortgage, home loan or LAP, loan against property. Unsecured, when we give a clean loan overdraft limit without any taking any collateral from the customer, right? So these are given to very good customers, those who are having good relationship with us. So we obtain a promissory note, demand promissory note from those borrowers. As soon as the bank decides to recall the loan, they will adjust the loan. So that is one is promissory note. Guarantee from third party, right? So we also ask for guarantee, please give us a guarantee, that is unsecured. Then a credit card is unsecured, personal loan is unsecured, right? And OD without any collateral is also unsecured against stock, OD against stock. Now there are three types of interest rate. One is fixed rate, that is generally connected with your whatever the MCLR is there in that present date, as on date of advance, right? Plus adding of NIM to that MCLR, and floating rate. As the MCLR changes, the rate of interest also changes accordingly. So in home loan, customer is given option to either opt for a fixed rate of interest or floating rate of interest. or mix of both, partly fixed, partly floating. So you have to sensitize your customers which is more beneficial to him. So fixed rate will remain throughout till the loan is repaid. Floating rate, as the MCLR is reviewed every quarter, it will keep on changing. If it goes up, rate of interest will go up. If it goes down, rate of interest in the loan account will go down. So we call it floating. Floating with a table code, an interest table code, right? That is tagged to a code. As soon as bank changes that and an entry is made at the data center, rate of interest changes in case of floating rate of interest, but it remains the same in case of fixed rate of interest. And third, we have both mixing. Tenure repaying capacity. So for car loan, generally we have 3 to 5 years. If it is a heavy costing car, we go up to 7 years also. Home loan 10 years, 15 years, 20 years, depending on the bank's guidelines. Loan eligibility, we check the CIBIL record, we check his credit score, we check his financials, we check his salaries, how much is he getting per month, what is the FOIR, fixed income to obligation ratio, margin, and loan to value ratio, LTV. So LTV is the loan that is given by the bank. Suppose LTV for home loan is 85%. And cost of the house is 50 lakhs. So bank will give 85% of the 50 lakhs only. Rest will be contributed by the borrower, that is called margin. And then we have credit scoring. We give retail loans generally on the basis of credit scoring. So that is out of 100 various parameters like his you can say wealth, or you can say investment, his savings, his credit score, his age, his risk profiling, his dependents, his liabilities, any existing EMIs are being paid or not, that is all given marks accordingly, and we either sanction the loan or we reject the loan, right? Then there is a negative list and caution list. So we check that negative list is generally declared by RBI, caution list is put by the banks. These customers may be risky. So there may be individual customers who are directors in any company and that company is in a caution list or negative list, or an individual has taken a loan and he is. Otherwise, CIBIL score will tell us that customer is repaying capacity is good or not, right? If he is having NPA, regular account, that will be reflected as a CIBIL score. And CIBIL score is between 300 to 700, 900, and 700 and above is considered good. What is his location? Is he in a good area? Past repayment history, CIBIL, we'll check from that, or his statement of account of the loans obtained from elsewhere, and list from regulatory authorities. Whatever regulatory authorities are there, we'll check that list also, right? We check that before giving a loan also. So let's just summarize. We just learned under retail loans, banks lend funds to consumers wishing to purchase high ticket items like home loan, car loan, which are short of capital, and it enables greater number of consumers accessing to retailers' goods. In home loan, there are a lot of taxation benefits like ETC. Whatever he has paid as principal in a financial year is covered under ETC of the Income Tax Act. Up to 1.5 lakhs he can avail that benefit. And section 24B, whatever interest he has paid in that financial year of the EMI, interest component of EMI, is given exemption under section 24 of Income Tax Act. The whole amount gets deducted from the taxable income. That's a huge benefit. So EMI consists of two parts. One is principal, one is interest component. So principal component ATC up to 1.5 lakhs, interest component 24B, whatever interest up to 2 lakhs is deducted from the taxable income. Under retail loans and overdrafts are provided either through secured, unsecured, fixed or floating rate of interest. We discussed that what is floating. It keeps on changing as the MCLR is changed. Fixed remain the same throughout the loan period, or an option is given to a customer even after 2 years, depending on bank's guidelines. So he may switch from fixed to floating also, and vice versa also. Retail loans are different tenures based on the life of the security earning of the borrower, right? So home loan takes a longer time because quantum of loan is higher. Depending on the age and the repaying capacity of the customer, we decides how much repayment period we can give him. Margin, whatever is contribution of the borrower towards that cost of the vehicle or home or whatever he is buying, is called margin. Based on credit scoring, the loan is sanctioned or rejected. And negative list or caution list provides to whom credit is to be given or whom to not to be given. So I think we covered very basic features of retail trade. I'll be covering in my loan module also lots of topics like loan against home loan, LAP, what are the features, where are various securities, how do we calculate FOIR, how do we calculate EMI, how do we calculate amount of loan that can be given to our customers. I shall be discussing in other videos. So friends, I hope you are enjoying this. Have a great time and thank you so much.